Hello traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the golden pocket trading strategy, a precise area on your chart that many professional traders use to pinpoint high probability entry and exit points. Understanding how to identify and trade with the golden pocket can give you an edge in the forex market, helping you spot potential reversals and manage your trades with great confidence. So stay with me until the end of this video to learn exactly how you can apply this powerful technique to your own trading strategy and start making more informed decisions in any market condition. Now, we start by understanding what the golden pocket is, and this is a specific area in your chart that traders watch closely for potential price reversal. It is found using the Fibonacci retracement tool. It's found using the Fibonacci retracement tool, which helps you to measure how far price has moved from a recent swing high to a recent swing low, or vice versa. The golden pocket is a zone between the 61 region and 65 region. So it's between this 61 region and this 78 region. Now let's look at a good example. This is basically what we are talking about. Drawing it in a bullish scenario, we'll draw it from the swing low to the swing high, and our golden pocket region is between this 78.60 level to the 61.80 level. As you can see, price came into that area before it reversed. Let's look at this other example. The same happened. Price did not get to this area. Let's see a good example on this time frame. We can see price got to the 61.80 level, between the 61.80 level, before it reversed to the upside. So all you need to know how to do is to plot your Fibonacci retracement tool from the most recent swing low to the most recent swing high in a bullish trade, while in a bearish trade you need to plot it from your recent swing high to your recent swing low. This is where how you plot it in a bearish scenario. Now let's see how we can trade using the golden pocket. Trading with the golden pocket involved a systematic approach to identifying high probability entry and exit points based on your Fibonacci retracement levels. So let's look at a step-by-step process to help you with this strategy. The first step is to identify your trend, and as we can see in this area of the market, we are trending to the downside. You can see we are trending to the downside, making series of lower highs, lower lows, lower highs, lower lows, lower highs. This is how we are trending to the downside, then lower low. So to continue in this direction of the trend is where we are going to implement this our golden pocket strategy. Once you have confirmed the trend, you apply your Fibonacci retracement tool. You plot it on your level. In a bearish scenario, you plot it from your swing high to your swing low. This is where you will plot it from your swing high to your most recent swing low. Now you will have to wait for price to get into your 61.80 level to your 78.60 level. This is the area, this is our golden pocket area. So once price gets to that area, this is where you would want to enter your selling position, stop loss above the most recent swing high. Then you aim for your 1:2 or 1:3 as the case may be. Now you can always look for confirmation before you enter your trade. When price gets to this your golden pocket region, you can always look for a candlestick confirmation before you enter. You can look for a bearish engulfing that engulfs your previous candle, or you can look for a doji candle followed by a bearish candle. You just need to look for a confirmation before taking your trade. Now let's look for another example. Let's look for a bullish example to pass this message. As you can see in this area, you draw it in a bullish zone, in a bullish market. You draw it from swing low to the most recent swing high. When price gets to your golden pocket area, which is your 61.80 area to your 78.60 area, you would want to place your trade after you have seen your candlestick confirmation. This is a bullish engulfing. If we decide to go to a lower time frame, we'll see a stronger, we'll see better confirmation. Let's use the 15 minutes. When we go to the 15 minutes time frame, let's look for this area in our chart and do justice to this. In this area, we can see, if I zoom in, when price got to that area on the 15 minutes time frame, which is a lower time frame, you can still see an engulfing candle at that area. So you would want to enter after you have seen your confirmation. Some people wait for a retest, but you will need to enter not to miss out. So when you enter your trade after your confirmation, stop loss, do not forget, just below the recent swing low or swing high in case of a bearish trade. Then you aim for your 1:2 or 1:3 as the case may be. So confirmations are actually important. You need to always incorporate confirmations into your trading strategy. Now let's look for another example. And as you can see in this area, this is a good trading area. Remember, you would have to draw your Fibonacci. In a bullish trade, this is a bullish market because price broke this swing high, showing that we are in a bullish market. You will draw your Fibonacci tool from swing low to the swing high, the most recent swing high. You wait for price to get to your 61.80 level. You can go to the lower time frame to get a better confirmation, but from this time frame you can see there was a bullish engulfing candle. You would enter after the engulfing candle. Your stops just below your recent swing low. Then you aim for your 1:2 or 1:3 as the case may be. You can also combine this with other tools. You can combine your golden pocket with other technical analysis tools. You can also look for alignment within support and resistance, or you can also make use of your RSI indicator, your moving averages, to further strengthen that trade you are about to take. And as we can see, if you can filter this with our RSI, we can see it is above the 50 region, signifying that there is cause for higher prices. Do not forget that you would always have to learn how to manage your trade effectively. Remember that once you execute a trade, either a long trade or a short trade, you have to put your stop loss beyond the golden pocket region, your swing low in case of a bearish trade, a bullish trade, and in a bearish trade just above your swing high. This will help you to manage your trade and minimize your risks. Do not forget, position sizes matters. Always risk nothing less than 1% of your, nothing more than 1 to 2% of your account, to avoid unnecessary blowing of accounts. to ensure that you stay in the trading game for a longer time. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thanks for watching, and I will see you in the next video.